Good day, and welcome to the Ameris Bancorp Fourth Quarter 2019 Financial Results Conference Call. All participants will be in listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. Please note this event is being recorded. I would now like to turn the conference over to Nicole Stokes, Chief Financial Officer. Please go ahead.
Thank you, Sarah, and thank you to all who have joined our call today. During the call, we will be referencing the press release and the financial highlights that are available on the Investor Relations section of our website at amerisbank.com. I'm joined today by Palmer Proctor, our CEO, and John Edwards, our Chief Credit Officer. Palmer will begin with some opening general comments, and then I will discuss the details of our financial results before we open up for Q&A. Before we begin, I'll remind you that our comments may include forward-looking statements. These statements are subject to risks and uncertainties. The actual results could vary materially. We list some of the factors that might cause results to differ in our press release and in our SEC filings, which are available on our website. We do not assume any obligation to update any forward-looking statement as a result of new information, early developments, or otherwise, except as required by law. Also, during the call, we will discuss certain non-GAAP financial measures in reference to the company's performance. You can see our reconciliation of these measures and GAAP financial measures in the appendix to our presentation. And with that, I'll turn the call over to Palmer for opening comments.
Thank you, Nicole, and thank you to everybody who's joined our call this morning. I'm excited to share a few highlights about the quarter and the year, and then I'd like to spend some time discussing the plan and opportunities we have going into 2020. For the quarter, we earned $66.6 million, or 96 cents per diluted share on an adjusted basis. And this represents a 1.47 return on average assets and an 18.45 return on tangible equity. As expected, our efficiency ratio improved this quarter to 55.61% as we continue to realize our cost saves from the Fidelity acquisition. And for the year 2019, we earned $222.9 million, or $3.80 per diluted share on an adjusted basis. And this is up 12% over 2018. This represents a year-to-date return on assets of 1.52 and an improvement from the 1.50 reported last year. I'm also pleased to report that our efficiency ratio improved during the year from 56.19% last year to 55.67% this year. On our third quarter call, I reviewed what we said we were going to do when we announced the Ameris and Fidelity merger, and how we were tracking with those plans, and I'm pleased to say that we continue to be on track with the plans. The core data conversion, as many of you know, was completed in November, as planned. As any conversion, we certainly identified some things we can do better next time, but overall the conversion went very well. We also closed 2 additional branches in the fourth quarter, bringing the total branches closed 29. We've had very little to no attrition of core deposits from these closures. And one final example I wanted to share on how close we are to the stated plan is that we had previously guided that we expected double-digit growth in tangible book value in 2019, and that's even with the Fidelity dilution. And our actual growth in tangible book value was 10.5% for the year. That announcement, we had modeled our tangible book value would be right at $20.80, and at the end of the year, we came in at $20.81, which was exactly in line with projections. And this is quite an accomplishment, and we remain focused on that tangible book growth. Now I'd like to turn our attention to the current plan. We recently spent several days with our board of directors on our strategic planning, and I have to say we all walked away extremely energized about the future. When you look at the markets we operate in, we have critical mass and we've got tremendous opportunity. And many of our markets, as you know, are high growth areas with estimated growth rates of anywhere from 9 to 11%, such as Atlanta, Orlando, Jacksonville, Columbia. Of course, the list goes on. But yet we still have the stability and the core strength of our non-metro stable markets as well. Everyone keeps talking about the disruption and how they're going to capitalize on it. And while we remain opportunistic in our markets, we also are fully aware that we are in control of our own destiny. We continue to look for and recruit top talent. but also have the luxury of knowing that we can be successful in 2020 with our current A team that we have in place. So our focus remains for the execution of our organic growth strategy without distraction of M&A at this time. And that focus really includes 4 core strategies. First one being the core deposit funding. Second is asset quality. Third is operating efficiencies. And last but not least is growth in the tangible book value. And these are all strategies that will continue to drive shareholder value for the company. I'll stop there now and turn it over to Nicole to discuss our financial results in more detail.
Thank you, Palmer. As you mentioned, we're reporting adjusted earnings of $66.6 million or 96 cents per share for the fourth quarter compared to $45.9 million or 96 cents for the fourth quarter of last year. These adjusted results primarily exclude the merger charges, the losses on the sale of branch buildings, a partial reversal of the gain on BOLI, MSR impairment, and expenses related to the government investigations that we announced in the fourth quarter. Including these items, we're reporting GAAP earnings of $61.2 million or 88 cents per share. The $66 million of adjusted net income represents a 45% increase over the fourth quarter of last year, and the 96 cents per share EPS is consistent with what we reported last year. Our adjusted return on assets in the fourth quarter was 147, which was a slight decrease from the 157 reported last quarter and the 161 reported in the fourth quarter of last year. Our return on assets was negatively impacted during this quarter by elevated loans held for sale balances as we integrated our mortgage delivery teams amid record production levels. For the full year 2019, our adjusted ROA was 152 compared to 150 last year. Our adjusted return on tangible common equity was 18.45 in the fourth quarter of 19 compared to 18.95 last quarter and 20.95 in the fourth quarter of last year. For the full year, our 2019 adjusted return on tangible common equity is 18.74 compared to 19.18 last year. As Palmer mentioned, we remain focused on tangible book value. For the quarter, we saw an increase in tangible book of 52 cents to end the quarter at $20.81. Ironically, this is the exact tangible book value per share that we had at June 30 of 2019, the day before the Fidelity acquisition. For the full year of 2019, we had an over 10% increase in tangible book value, up $1.98 per share from the $18.83 at the end of last year to $20.81 at the end of this year. We're pleased with this increase in tangible book value, considering it absorbed the Fidelity as well as the repurchase of about $18.5 million in stock during the year. During the fourth quarter, our net interest margin increased by 2 basis points from 384 to 386. This increase is mostly due to additional accretion income during the quarter related to the workout of a problem loan that had a large discount tied to it, and also early payouts from acquisitions. I don't think that future accretion income will be as high as the fourth quarter, and I think it will normalize in 2020 to about an average of $3 million per quarter. Also in the fourth quarter, the elevated mortgage loans held for sale negatively impacted our margin by 8 basis points. I know I said last quarter that we expected to shrink that during the fourth quarter, but based on production, it actually increased. Basically, our mortgage group refilled the bucket faster than they were selling. I don't want to sound like a broken record, but we are monitoring that level daily, and we have sales currently pending to bring that balance down by the middle of the first quarter. I believe the ongoing balance going forward will be in the closer to the $900 million range. I'd previously guided that in the $500 to $600 range, but I think with the two mortgage companies coming together and our elevated level of production, we'll stay in that $900 million range going forward. During the fourth quarter, our yield on earning assets declined by 4 basis points, while our interest-bearing deposits and total funding costs both decreased by 10 basis points. And for the year-to-date, our margin declined 4 basis points from 392 to 388, even with the 3 Fed cuts throughout the year. And during the year, our yield on earning assets increased by 17 basis points, while our funding costs increased by 34 basis points. Non-interest income grew over 80% from the fourth quarter of 18 to the fourth quarter of 19. The increase in service charge income due to the additional deposit accounts from Fidelity was partially offset by the Durbin impact, and our mortgage revenue grew over 179% this quarter compared to fourth quarter last year. Mortgage production was strong in the fourth quarter at $1.6 billion compared to $414 million fourth quarter last year. We saw a slight decline in the gain on sale percentage, and we anticipate that will return to higher levels in 2020 as we continue to manage product mix and pricing models between Fidelity and Ameris. Our adjusted efficiency ratio improved to 55.61 this quarter from 57.25 last quarter. And for the full year 2019, our adjusted efficiency ratio improved from 56.19 to 55.67. We completed, as Palmer said, the core system conversion in November, and we anticipate the realization of all cost saves by the end of the first quarter 2020, as we still had some administrative cost overhang in the fourth quarter numbers. However, some of these costs in the first quarter will be offset by typical first quarter cyclicality, such as the increased payroll taxes that we will see in the first quarter. Total non-interest expenses were $122.6 million for the quarter. However, when you remove the management adjustments such as the merger and conversion charges that I already mentioned, our adjusted non-interest expenses totaled $118.3 million, down $8.5 million from the third quarter. Approximately half of that decrease was in the core bank and administrative functions, while the other half was in the mortgage line of business, mostly in salaries and commissions. On the balance sheet side, we ended the year with total assets of $18.2 billion compared to $17.8 billion last quarter and $11.4 billion last year. We were pleased with our organic growth both on the loan and deposit side. Excluding the Fidelity acquisition, organic loan growth was $751 million, or 9.16% for the year. Organic loan growth this quarter slowed, mostly due to seasonality and the continued repositioning of various portfolios. Total loan production in the bank was actually $1.1 billion, up over 81% from the fourth quarter of last year. Yields were down on new production, which was to be expected due to the recent Fed cuts. On the deposit side, we continued the momentum on non-interest-bearing deposits and improved our mix so that non-interest-bearing deposits now represent 29.94% of total deposits compared to 26.12 a year ago. And for the full year of 2019, our non-interest-bearing deposit growth was just over 15% as our bankers continue to be focused on core deposit growth to fund the overall bank growth. At the end of 2019, our loan-to-deposit ratio was 91%, compared to 94% at the end of the third quarter and 88% at the end of last year. And credit quality remained strong. As you recall from our last call, we saw a slight bump in NPAs due to the Fidelity acquisition during the third quarter. Our team was able to liquidate a significant portion of Gene Mays that caused that bump, so we're pleased to report that our non-performing assets as a percentage of total assets decreased 17 basis points, down to 56 basis points at the end of the year. This compares to 73 basis points last quarter and 55 basis points this time last year. For the quarter, our annualized net charge-off ratio was 9 basis points of total loans, 17 basis points of non-purchase loans. For the full year of 2019, our annualized net charge-off ratio was 10 basis points of total loans and 15 basis points of non-purchase loans, compared to 18 basis points of total loans last year and 27 basis points of non-purchase. With that was a lot of numbers. With that, I'll turn the call back over to Palmer.
Great. Thank you, Nicole. I said in the earnings release, and I'll mention it again here, we went through a tremendous amount of change this year, including the largest conversion and integration in our company's history. And to execute on our plan and deliver these types of financial results while having the distraction of everything that's happened this year is quite an accomplishment, and I couldn't be more proud of our team. From the support staff to our customer-facing teammates, these results are truly a group effort of a new combined Ameris team. And as we look forward into 2020, we remain optimistic about the opportunities for growth, and especially in the diversified lines of business that we have. However, that being said, we do operate in a very competitive market and will not compromise asset quality for the sake of growth. So I'll close with this message again, is that you will see Ameris continue to become more and more active, but not more aggressive. I'd like to thank everyone for listening to our fourth quarter earnings results, and we look forward to 2020. Now I'll turn it back over to Sarah for any questions from the group.
We will now begin the question and answer session. To ask a question, you may press star then 1 on your touch-tone phone. If you are using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star then 2. At this time, we will pause momentarily to assemble our roster. Our first question comes from Tyler Stafford with Stephens. Please go ahead.
Hey, good morning, guys, and thanks for taking the questions.
Sure. Good morning, Tyler.
Hey, I hopped on a couple minutes late, so I apologize if you covered this in the prepared comments. But Nicole, I did hear the outlook about the held for sale balances coming back down towards around $900 million. So my question is, one, how quickly do you think it will get back towards that level? Is that happen in the first quarter? And then just in terms of the held for investment growth expectations for the year, can you guys comment on what you are expecting there?
Sure. So first I'll talk about the mortgage loans held for sale. So we have sales in progress today, so that we anticipate that will come down by the end of the first quarter. And I realize that I said that at the end of the third quarter, but we have allocated some additional resources to make sure that does happen in the first quarter. And like I said, we are monitoring that daily. We're still funding that with short-term FHLB advances. So as soon as that comes down, the FHLB advances can go back to normal levels as well. And I don't know, just to reiterate that was about an 8 basis point decrease on the margin in the fourth quarter, having those lines go up instead of down. So, and then your second question was on loan growth, and I think this goes a little bit to what Palmer has alluded to, is that we are going to become more active but not more aggressive, and that we are very cognizant of credit quality. So as we see things in the market changing, we will react accordingly. So I think in the past we have guided loan growth in the 7 to 9%. I think that will soften a little bit and could come more in the 5 to 7. I think all of our analysts are close to that 7%, but I definitely think that could come down a little bit from the 7 to 9 that I previously guided. Would be closer in the say 5 to 7, 6 to 7.
And just to be clear, Nicole, is that 5 to 7 solely for held for investment growth, or is that in the totality, point-to-point, total loan growth, which includes the runoff or the declines in held for sale?
No, that is just the held for investment. Okay.
All right. Perfect. Thanks for clearing that up. So with that, I guess, reversion of the held for sale balances by the end of the first quarter, can you just talk about the kind of margin expectations given, continued funding cost relief with, you guys were funding that held for investment, I think, with FHLB advances, so I assume those are going to come down, and then the held for sale balances will come down. So lots of kind of moving pieces there. Can you just give us a little bit of color on where you see the margin from here?
Sure. No, I think that's a great question, and you said that very well. So you've got several components. So we've got the mortgage loan held for sale piece that as that comes down and the FHLB borrowings come down, again, that was 8 basis points in the fourth quarter, assuming that we get that for at least half the quarter. So I think that could be a 3 to 4 basis point pickup in the first quarter based on when I think that balance is going to normalize in the first quarter. Again, that's on when we're talking about GAAP margin. And I don't necessarily focus on the margin excluding accretion just because that's a non-GAAP measure. But when you look at our when you look at our GAAP margin this quarter, that went up 2 basis points, we did have that elevated accretion in the quarter, that we also had the loan for sale hit. So the net of those two was the positive 2. When you look at our margin excluding accretion, that fell during the quarter by 11 basis points, but that did not have the accretion pickup, but it only had the held for sale pickup or decline. So our margin excluding accretion could potentially increase next quarter because that accretion bump is already out of that number, but we will have the pickup from held for sale. When we look at our balance sheet, we really do have, especially if the Fed holds with no additional rates, we are very much asset neutral in both the short term and the long term. We actually have some positive momentum coming in on the deposit side. We were pleased with our reduction in rates there. But to give you an example, we have about 62% of our upcoming CDs that are maturing are greater than wholesale funding costs today. And just to give you an update on December, as an example, our CD production in December, so our maturing CDs that rolled into new CDs, they average a 56 basis point decline in those CDs. So that is, when you think about fourth quarter really we absorbed 2 Fed cuts. We absorbed the September Fed cut and the December, because September was so late, and then also the December. So to be able to say that our December CDs repriced 56 basis points, that's a greater than 100% date on those repricing of CDs, which we were very pleased with. That was probably too many details, but that just kind of gives you some color on some momentum that we have going in.
Yeah. Okay, so maybe just to summarize, the margin excluding the accretion as we head into 2020 should have a few basis points of upward movement given the lower held-for-sale balances. Is a few basis points of tailwind the right kind of way to think about that for the first quarter?
That's exactly right. For the net interest margin excluding accretion.
Yes.
And then our GAAP margin, I anticipate being fairly consistent.
Got it. Okay. I will hop out and let somebody ask questions. Thanks.
Great. Thank you, Tyler.
Our next question comes from Casey Whitman with Piper Sandler. Please go ahead.
Good morning, Palmer, Nicole. How are you?
Good morning.
Just, I guess, first I'd touch on capital. So you brought back, a small amount of shares in the quarter, but maybe just update us on your thoughts around capital management here and the use of buybacks as we think about 2020.
Sure. So our stock buyback, we did, in September, our board renewed for another $100 million of stock buyback, and we realized that, and we were sitting here saying that we are very cognizant of tangible book value and we want to preserve capital at this point. And so a stock buyback is a little bit counterintuitive that, but I think we will be opportunistic. We like having that in our tool belt. I don't think that we will go out if we have $100 million approved. Our plan is not to go out and buy $25 million a quarter, but if we can buy a little bit each quarter, bring back a little bit of shares, but be able to absorb that tangible book value along the way, that's kind of what we're doing. Again, it's not our number one strategy, but we'll be opportunistic if the opportunity comes up to buy, 5 to 6 million shares a quarter, or dollars worth a quarter.
Understood. And then just thinking about expenses, I guess my first question would be: Are there more like one-time costs to come between additional merger charges, sales of bank premises, anything like that you expect going forward, or is it a pretty clean kind of run rate going forward here?
We feel like it's a clean run rate going forward. The only thing that we feel, when you look at what we adjusted for management adjusted, the things that will go forward, unfortunately, are the government investigations, legal fees, concerning that. Will continue to be there. And then also the branch sales. I mean, if we have empty branch buildings and we have an opportunity to sell, we have current appraisals on all those and we feel like they're valued correctly, but you always have the opportunity that if one came along and you had a a loss on that. But as far as merger and acquisition, we feel like all of that is behind us. We've got all of that accrued and recorded in 2019.
Okay. And then just to be clear on just the remaining cost saves coming out, are those coming out of the bank segment, mortgage segment, or kind of a combination of both?
It's a combination of both. We have still, I would say, of what's left, we've got, it's probably split 70-30 in kind of what I'd say lines of business, being whether that's mortgage, and then the other 30%. Well, actually, I'll make that back. I'm looking at the numbers. It's closer 60-40. 60 in mortgage and 40 in administrative and bank side. Okay. I guess, and then just one last question I'll ask on our credit. Do you guys have a preliminary estimate for the loan loss adjustment for CECL, or any kind of commentary around what the day two impact might be on provisioning levels? Sure. We actually we're working on the disclosures for the 10K, so that will be much more robust. So I'm going to be a little bit hesitant until we get all of that out in the 10K in just a few weeks. But we have all of our day one, day two entries. So we have a lower boundary and an upper boundary. And our lower boundary, and we're going to give a range, it's about a $30 million range that we'll put in the 10K. And that range, the lower range of that is very, very close to what we've said all along being our total allowance plus our total discounts. However, there's a portion of those discounts that are not on PCD loans, so that will continue into our accretion, and that rolls into that $3 million accretion number I gave. So there will be a day one entry to retained earnings for the portion of going into the CECL allowance that was not in our discounts. Just to give, I will say on our unfunded commitments, that's a new component for CECL. That range we believe is 12 to 17 million, and that was not covered in our allowance or our discounts previously. So that is definitely a day one. And then we also have an additional that will come in as well in the first quarter. But we believe that the total adjustment, we know that the total adjustment in the first quarter is in line with our expectations and will be absorbed by earnings in the first quarter. We shouldn't see capital go down at the end of the first quarter like some banks might.
Okay. Great. Thank you for taking my questions.
Thank you, Casey.
Our next question comes from Brady Gailey with KBW. Please go ahead.
Hey, thanks. Good morning, guys.
Good morning.
So when we're talking about 5 to 7% loan growth just held for investment loans, does that include the impact of continued shrinkage of the indirect auto book?
It does. That 5 to 7 is net of that runoff.
Okay, great. And then looking at mortgage fees, now I know fourth quarter is a seasonally soft quarter for mortgage, but we've seen some mortgage peers have relatively good mortgage quarters this quarter. Looking at your mortgage fees, they were down about 37% linked quarter on annualized. Is there anything to note that would be included in those mortgage fees? I thought they would come a little better. So is there anything one time or anything to note within that mortgage fee line?
No, I think it's actually that the third quarter was such an anomaly. The third quarter was very, very high for us. I mean, it was higher than we had projected with the Ameris and the Fidelity combined, and so I think fourth quarter was in line. I know that there was an article that there's another bank that picked up some of our mortgage bankers, and I think I had that number right in front of me of what our Florida production was, but there was not a decline in our Florida production. When you look at production in the mortgage, our overall, and most of this also, well, I'm jumping around a little bit, I don't need to do that. So third quarter, our production was $1.8 billion, and our fourth quarter production was $1.6. So that's a very small decline, and a lot of that is just normal fourth quarter cyclicality. Our gain on sale percentage dropped from about 7 basis points, so that accounted for some of that, and like I said, we anticipate that going back up as we kind of work through some of the product mix and the pricing.
Right. Brady, more specifically, your question, mortgage is still extremely robust for us, and the Florida production this month was a record high. In fact, we did more volume this month in Florida, this quarter in Florida, than we have historically in Florida, with the exit of several of those operations folks and a few of the originators. So we feel good about the production, and if you look, more importantly, one of the things we've always focused on and pride ourselves on is the purchase originations, and if you compare last year's purchase origination volume, fourth quarter to this year's, it's almost triple. So that kind of gives you an idea of the magnitude of the volume that we've been able to generate, especially when you combine two large mortgage operations. So Robert Odom and his team have done an excellent job of doing just that.
All right, that's helpful. And then finally for me, Palmer, I hear you on the M&A pause. We have seen, several notable Southern merger of equals, so not the traditional one bank buying another, but kind of an MOE style deal. Is that, when you say an M&A pause, are you more talking about, you guys just continuing to buy other banks? Or would you consider, some sort of big picture strategic MOE with a like-sized bank at this point?
Well, I think we've been pretty consistent in our response there. Our focus remains on the organic opportunities we've got in these incredible markets we're blessed to be in. So we just don't need that distraction right now. We're getting the Fidelity acquisition fully integrated. We've got all the right people in the right seats, and there's just tremendous opportunity here, and we just don't need any distraction from M&A right now, and that's very consistent with the 4 to 6 quarters that we had said from the inception. So nothing's changed there.
Okay, got it. Thanks for the color, guys.
Mm-hmm.
Our next question comes from Jennifer Dumbo with SunTrust. Please go ahead.
Thank you. Good morning.
Good morning, Jennifer.
Nicole, question on expenses. You said obviously there's seasonality in first quarter every year, but you'll realize the rest of your cost savings from Lion. So as a result, do you think expenses will be flattish sequentially between fourth and first quarter?
I don't. I think there is still room for a slight decline from the fourth quarter of this year to the first quarter of next year. I do think it'll be a slight decline as we, continue to have, like I said, we had some administrative overhang. So even though conversion was November 1, we held a lot of employees, retained a lot of employees to make sure that was all clear before they were displaced. And so we do anticipate, but I just wanted to warn everybody, we always, seems like every first quarter, there's always, you've got payroll taxes and some various other things that increase. One thing I wanted to, maybe will help when we were looking back and kind of going through some of our budgeting and strategic planning, when you look at Ameris and Fidelity combined from 2018 to the 2020 expectations, our non-interest expense is about a 6 to 7% increase, but our revenue growth is greater than 15%. And I think that's really where we are working really hard to make sure that we execute on all of those cost saves and that we continue to drive revenue. But there are a few other projects that will help efficiencies where we're reallocating some resource. And so we're definitely working to keep that efficiency ratio in the 54 range, to continue to drive that down below 54.
Yeah. Okay. And I had to hop on a few minutes late. Can you talk about any merger disruption opportunities you guys have been able to capitalize on thus far?
Yeah, we've remained, Jennifer, focused on the customer side of that equation. Obviously, we continue to look and interview for opportunities with talent, but as I mentioned earlier, we're just fortunate to already have boots on the ground and talent in place to capitalize from the customer side. So a lot of the growth you're seeing, we've had some really good success on the core deposit funding side from the disruption, and the loan side remains extremely competitive, but we are getting a lot of looks at deals. Some are probably a little too rich for us in terms of pricing, but those opportunities I think will continue to exist as we move forward with the disruption in the market. We did hire this quarter. We focused the new hires we've had on the lending side have been predominantly on the C&I side, and there are a couple down in Florida, and then we've got 2 or 3 in Georgia that we hired this quarter.
Okay, great. Thank you.
Mm-hmm.
Again, if you'd like to ask a question, please press star then 1. Our next question comes from David Feaster with Raymond James. Please go ahead.
Hey, good morning, guys.
Good morning, David.
Just a quick one. Following up on the seasonal expenses, do you have could you quantify what the FICA and the payroll taxes are, just kind of on a combined basis? The expectations for the first quarter.
I can. Need to. Give me 1 second. Maybe I should sing and dance. Right? I don't have it right in front of me, but I will have it in just a second.
And I guess if there's, on the FDIC credit, if you guys have any remaining, and when you expect that to normalize?
We do have a little bit remaining, and we'll use that in the first quarter. And so you'll see that bump come in the first quarter as well. That is another thing that will come up.
I guess just I'll ask something on the hiring front. Have you seen any change in the tone of conversations or the pace of conversations? Anecdotally, I've heard that things that might have picked up now that some of the deals have closed, and I guess just what are your expectations for new hires in 2020?
Well, I'll tell you, our expectations are probably different than others in terms of our dependencies. We have less of a dependency on having to hire lenders as many others do that are new entrants into the market, just because, as I mentioned earlier, we've got so many people already in place to take advantage of the opportunities. But I do think, to your point, there is some acceleration in discussions. A lot of these payouts with the larger disruption, meaning the trip, those are February and March. And so I think you'll start seeing some movement first quarter there, into the first quarter. And that's when things, I think, will start to shift a little bit more. But right now, the main thing we've got our existing team focused on are the customer opportunities, in addition, obviously, to looking for new talent. But I think that shift will continue to accelerate this quarter.
And, David, that payroll taxes is a little shy of $2 million.
Okay, terrific. And then just kind of, we talked about it briefly, but, credit's been very benign for y'all. But I'd be interested to hear your thoughts on credit, whether you're seeing anything in the market that's causing you any concern, either in Florida or Atlanta, and just kind of the competitive landscapes in your markets.
Sure, David. The market is still pretty robust in general, especially in our four-state footprint. I mean, there are really very few lending opportunities that we aren't really looking at right now. But, the competitiveness, as Palmer put it, we're more active and not more aggressive. So the competitiveness of the landscape is maybe on the more aggressive side, and we've had to kind of really look hard at that. But from a market perspective, there's plenty of new investment going on. There's plenty of new growth. There's plenty of new folks coming in. So the markets still remain pretty robust.
Are there any specific segments where you're seeing that aggressiveness, and do you see it more in Florida or Atlanta? And I guess from whom? Is it the big guys or non-bank lenders?
I think you have to kind of define what aggressiveness is. I mean, if it's pricing, that's consistent throughout the markets in which we operate, and a lot of that is because we are in some very competitive markets. From an asset quality standpoint, most of the banks have been pretty disciplined from what we've seen out there. Where you start tinkering with structure, though, in terms of amortization or non-recourse, that's where we're starting to see a little more pickup on deals that we did not see in the past. But in terms of cash flow and operations and solid sponsors, that seems to be pretty consistent throughout. I'm not seeing large or small banks kind of get too aggressive on that front.
Okay.
It's mainly on the structure and terms. Yeah.
Okay. Thanks for the color.
This concludes our question and answer session, and the conference is also now concluded. Thank you for attending today's presentation. You may now disconnect.